Welcome back to One More Stock Channel. We are diving deep today into, well, one of the most polarizing and I think rapidly transforming companies in the financial world, Robinhood, ticker HOOD.
It's an absolutely essential topic right now. For most people, that name Robinhood, it still brings up memories of the early 2020s, right? The zero commission frenzy, the whole retail trading boom.
Totally, the meme stock era.
Exactly. But the insights we've pulled together from the One More Money blog, they just paint a radically different picture of the company today.
They really do, and that's our mission in this deep dive, to unpack those findings. We're looking at Robinhood's, frankly, radical transformation. They are no longer just a brokerage trying to compete on price.
Not even close.
They've become a profitable, crypto-first global fintech enterprise, and they're focused on this monumental, infrastructure-heavy tokenization strategy. All of this is happening against the backdrop of their phenomenal, record-breaking Q3 2025 financial results.
The transformation is staggering.
Yeah.
I mean, if you really boil it down, the core surprise from the One More Money blog is this. Robinhood already revolutionized how people access stocks, but now they're aiming to revolutionize the underlying technology of global finance itself.
That's a huge claim.
It is, but look at the plan. They want to tokenize everything, stocks, bonds, real-world assets, or RWAs, using their own blockchain and Layer 2 infrastructure. They're basically shifting from being a storefront that sells financial products to being the company that builds the new financial roads.
That is a fundamental shift in ambition. You're right. It's moving them from just a high-profile brokerage to a potential competitor of, what, exchanges, clearinghouses?
All of the above. It's a massive jump.
Okay, so let's unpack exactly how they achieved the profitability needed to even dream of funding this. We have to start with Section 1, Robinhood's evolution and the engine that truly drives the profits today.
Let's do it.
So when Robinhood first broke onto the scene, their whole identity was just one word: disruption. They championed zero-commission trading. They basically forced the hands of giants like Fidelity and Schwab to drop their own fees. That was their original revolution, wasn't it? Just lowering the barrier to entry for retail investors.
It was, and that accessibility model, it definitely earned them millions of users.
Yeah.
Immense visibility. But it didn't guarantee consistent profitability, especially not after that 2021 market boom started to cool off.
Yeah, that was a tough period for them.
It was. And the One More Money blog really highlights how quickly they adapted. Their current status is a highly profitable, global, multi-asset fintech platform. This wasn't just a pivot. It was a ruthless optimization. They figured out where the highest, most sustainable margins could be found.
And that leads us directly into their stated ambition for 2025 and beyond. This isn't just about, tweaking the app interface. It's about redesigning the entire global settlement mechanism.
That's the goal.
So what are they pushing toward with this ambition? What are the key pieces?
Well, there are really three interlocking goals. First, they are moving aggressively toward tokenizing stocks and other assets. Second, they're developing their own proprietary Layer 2 blockchain.
Their own, not using someone else's.
Their own. And third, they're committed to enabling true 24/7 trading, with the ultimate goal of moving financial assets entirely on-chain. This means every stock, every bond, every real asset will eventually be represented by a blockchain token on their network.
Moving assets fully on-chain. I mean, that just fundamentally changes the game. It removes layers of intermediaries, all these archaic clearing processes. It sounds like their focus isn't just on competing for U.S. stock market share anymore.
No, that's a crowded market.
Right. It's about controlling the underlying technology for the settlement of global assets. That's a blue ocean opportunity.
Exactly. They're applying a tech startup mindset to infrastructure that has been stagnant for decades. But to understand how a company that built its name on giving things away for free can afford this multi-billion-dollar investment, we have to look at the real profit engine. Payment for order flow, PFOF.
Yes, PFOF. It's controversial, but it's undeniably the core of that whole zero-commission model. Could you walk us through the mechanics, just for anyone who might not be familiar with how this works under the hood?
Sure. So PFOF is the mechanism that subsidizes that free trading experience. When you, as a customer, place an order to buy or sell a stock on Robinhood, that order doesn't go straight to the NYSE or NASDAQ.
Most people probably assume it does.
They do. But instead, Robinhood routes that order to a sophisticated intermediary, a wholesale market maker. We're talking about companies like Citadel Securities, Virtue Financial. These firms execute the order internally, and in return for getting this guaranteed fire hose of customer orders, they pay Robinhood a rebate.
This model has faced a ton of regulatory scrutiny, especially for U.S. stocks, right? Concerns about whether customers are really getting the absolute best price.
A huge amount of scrutiny.
Hmm.
But what the research from the One More Money blog lays out so clearly is that this PFOF model, it changes dramatically depending on the asset class being traded. And this variability, that's the key to understanding Robinhood's entire strategic pivot.
Okay, so this is the critical insight. The margins they capture per trade vary wildly.
Wildly. Let's start with the traditional side, equities. So normal stocks,
Yeah.
the margins here are incredibly thin. Robinhood might get, what, around 0.8 basis points in a rebate?
Less than 1 basis point.
Yeah, it's a volume game. You have to rely on millions and millions of trades just to generate meaningful revenue.
It's essentially a commodity business at that point.
It is. Now, move over to options trading, the right to buy or sell a stock at a specific price. The complexity and the risk go up, and so does the profitability. The margins here jump significantly, often to around 8 basis points.
Okay, so that's 10 times higher than the rebate on a single stock trade.
10 times higher. That's already compelling. But now we get to the real structural advantage crypto.
This is where it gets crazy, right?
This is where it gets absolutely astonishing. The One More Money blog reveals the margins on crypto range from 35 to an eye-watering 57 basis points.
Whoa, 35 to 57.
Yes. And when you compare that range to the less than 1 basis point they earn on stocks, you start to grasp why the company has pivoted its entire identity around digital assets.
Okay, let's just dedicate a moment to that. I want to make sure everyone really internalizes that difference. So if I do a standard stock trade, Robinhood earns, let's say, 1 unit of profit. If I do a crypto trade, they earn between 35 and 57 units.
Exactly. For the same amount of effort from the platform's perspective, it's an exponential difference in profitability.
Which is why crypto is now the core profit engine.
Precisely. And the main reason for this huge divergence is regulatory structure. Unlike U.S. equities, crypto transactions are currently not required to be routed through regulated U.S. national exchanges. And that regulatory freedom, it changes the entire game for the market makers.
Okay, so how does that freedom translate directly into higher rebates for Robinhood? What's the mechanism?
It just creates a much more favorable environment for the market makers, which then benefits Robinhood. Because the regulatory oversight is lighter, a few things happen. First, the market makers have far more flexibility in setting the bid-ask spread, the difference between the highest price a buyer will pay and the lowest a seller will accept. They can widen that spread a bit more than they could in the highly regulated stock market.
I see. So there's more profit baked into the trade itself.
There is. And second, there are fewer stringent requirements around achieving best execution, which means the market makers can capture more profit from the execution, and because of that, they can afford to pay Robinhood a much, much larger piece of that margin as a rebate.
So the whole chain of transactions is just structurally more lucrative. The market makers make more, so they can pass more back to Robinhood?
That's absolutely correct. The key statistical takeaway, the one fact that dictates their entire future strategy, is that crypto trading generates anywhere from 30 to 70 times more revenue per order than equities.
30 to 70 times.
Yeah, I mean, if you're a CEO looking at your business data and you see one product line generating 70x the return of your flagship product, you don't just, add a new feature. You fundamentally redesign the business around that profit center.
That reframes the entire narrative. Robinhood didn't become a crypto-first company because they suddenly became Bitcoin evangelists.
Not at all.
They do it because the margins demand it. It's a business decision, pure and simple. The pursuit of the highest margin activity explains the pivot, the infrastructure investment, and the global expansion.
It explains everything.
Okay, so that brings us to the results of that strategy. Let's look at the financial performance and this profitability turnaround. The numbers for Q3 2025 are just massive.
They are.
But to really appreciate them, we have to recognize the turnaround it took to get here. Robinhood was really struggling after the post-lockdown trading frenzy subsided, right? They were incurring heavy losses.
They were. The One More Money blog emphasizes this was a dramatic shift. They had to become a lean, operationally profitable platform. And it wasn't instantaneous, but the full year 2024 results were the definitive proof of concept.
What did those look like?
They reported roughly $2.95 billion in revenue for 2024, but the real headline was the massive reversal in profitability. They achieved $1.41 billion in net income.
A huge reversal.
And this wasn't just, cutting costs. It was a fundamental shift, heavily driven by high interest income on their huge cash balances and increasingly that high margin crypto revenue we just talked about.
And that momentum didn't just carry into 2025, it accelerated. Q1 saw revenue jump 50% year over year, hitting $927 million, net income of $336 million. Then Q2 continued that trend, nearly hitting $1 billion in revenue.
Q2 was really important and provided these crucial signals that the strategy was working. Crypto trading revenue was $160 million. That's nearly double the previous year, showing that high-margin engine was really firing up.
And what about the customer metrics?
Strong. We saw 3.2 million gold subscribers, platform assets surging past $221 billion. This confirms users aren't just using the free service, they're adopting the higher yield, premium features, which creates a much stickier revenue base.
So if Q2 was strong, the One More Money blog described Q3 2025 not just as strong, but as a major inflection point. This is where the strategy really collided with favorable market conditions to create these explosive results.
Exactly. Q3 2025 was a demonstration of their operational maturity and the leverage of their platform. They delivered a record quarterly revenue of $1.27 billion.
And to put that in context,
It was a staggering 100% year-over-year increase. It just comfortably surpassed all analyst expectations.
and crucially, the bottom line didn't just grow linearly with the revenue, it expanded exponentially.
That's the definition of operating leverage in action. Net income reached $556 million. That's a massive 271% jump year-over-year.
271%.
Yeah. Earnings per share surged to 61 cents, beating estimates by a big margin. When your revenue doubles but your net income nearly quadruples, it tells you your underlying infrastructure costs are fixed. It means every new dollar of revenue is extremely profitable.
And that high operational efficiency is also reflected in the adjusted EBIT figure, right?
Absolutely. The adjusted EBITDA hit $742 million. EBITDA is a measure of pure operational profitability, and a number that high just confirms that all those previous heavy investments in technology, scaling their systems, handling massive volumes, are now delivering huge returns with minimal marginal cost. They've built a machine that's incredibly efficient at turning revenue into core profit.
Okay, let's drill down into where that revenue came from. We know transaction revenue was huge, but what drove the activity?
So transaction revenue soared to $730 million, and it was primarily fueled by trading activity. At the very head of the pack was a colossal 300% surge in crypto trading volumes.
300%.
This figure just massively outperformed every other asset class on the platform. It reaffirmed crypto as the central, high-growth, high-margin driver of the entire business.
Okay, a 300% surge is immense, but the critical question is, was this just because the whole crypto market was up, or was it a reflection of Robinhood's specific strategic success?
The One More Money blog suggests it's a bit of both, but with a strategic tilt. Yes, market sentiment was generally positive, you can't deny that. But a 300% surge suggests Robinhood is capturing a disproportionate amount of market share.
Why, though?
It's likely due to their aggressive international expansion and their unique ability to offer high-demand tokens faster than some of the more traditional platforms.
And while crypto was leading the charge, the legacy business, the stock trading, also showed signs of life.
It did. Retail investors were back in force. Equity volume increased by a very robust 132%, which shows the platform benefits significantly from renewed market enthusiasm. The combination of high-volume equity PFOF and that explosive high-margin crypto PFOF just created the perfect financial storm for their record revenue.
So that covers the transactional and, inherently volatile side of the business. But the blog also points to a stable pillar that gives their earnings some durability.
Right, and that's the net interest revenue. This is the revenue they get from things like customer margin balances, securities lending, and just holding customer cash reserves at elevated interest rates.
A very stable, recurring revenue stream.
Exactly. And in Q3 2025, it increased 66% year over year to $456 million. In times of high trading volatility, that stability is crucial. It acts as a financial buffer, insulating the whole profitability profile.
Beyond the financials, what about platform stickiness and adoption? How are the customer metrics looking?
The gold subscription model is working brilliantly. They saw continued, strong adoption of premium features, with gold subscribers climbing to 3.9 million.
So people are willing to pay.
They are. It shows users are willing to move beyond the free tier to get things like higher interest rates on their cash or advanced trading tools. And on top of that, funded accounts rose 10% year over year to 26.8 million, which just confirms Robinhood's enduring position as a major gateway for new investors globally.
Okay, so Q3 wasn't just about the financial results. There were also some key strategic signals for the future.
Yes, definitely. We had a leadership change announced. Shiv Verma is slated to take over from CFO Jason Warnick in the first quarter of 2026. This signals a transition as the company matures from its, hyper-growth startup phase into a global, complex enterprise dealing with sophisticated international and regulatory challenges.
And their expense guidance for the full year seems to confirm their aggressive infrastructure plan.
Absolutely. They raised their full-year 2025 adjusted operating expenses guidance to around $2.28 billion. Now, in many cases, raising expense guidance would spook investors.
Right. It usually means lower profits.
But here, it reinforces the message that they are aggressively investing in their future platform, specifically that global infrastructure and the tokenization roadmap we discussed. They're spending money to capture this vast opportunity presented by the on-chain transition.
They also launch prediction markets. What's the strategic significance of that?
Prediction markets are highly strategic. They blend trading, forecasting, and a kind of gamified experience. It diversifies their transaction revenue beyond just simple asset exchange. It taps into the appetite for sophisticated yet accessible financial instruments. It's an innovative way to generate revenue from their established user base.
And finally, the critical component of their global strategy, the acquisition of Bitstamp.
The Bitstamp acquisition is arguably the most important strategic move of the quarter. Bitstamp is one of the oldest and most respected global crypto exchanges. This isn't just about adding users, it's about instantly accelerating Robinhood's international footprint.
It's about infrastructure and licenses.
Exactly. Bitstamp brings with it a host of established regulatory licenses, operational infrastructure, and immediate access to major European and Asian markets. It positions Robinhood not as a U.S. brokerage with crypto, but as a bona fide global crypto trading hub, which is essential for their goal of tokenizing global assets.
Okay, so we've established the profit engine and the financial momentum. Let's pivot now to the technical architecture that enables this whole global transformation. This is the tokenization roadmap. This is where Robinhood moves from simply offering crypto trading to building the foundational infrastructure for tokenized finance.
Right, and the first concrete step in this roadmap, which they launched mid-2025, was highly innovative. They introduced tokenized U.S. stocks and ETFs in Europe, but critically, these are backed by CFD structures, contracts for difference.
Okay, we need to slow down here. Let's make sure everyone understands what a CFD is, especially in this context. How does that mechanism work, and why is it such a brilliant move for Robinhood?
So for anyone unfamiliar, a CFD is a derivative instrument. It means users get synthetic exposure to the underlying asset like Apple stock or an ETF without actually owning the physical shares.
Okay.
Think of it like this. You're essentially signing a contract with Robinhood that says, I am betting on the price movement of this asset.
So they don't hold the physical U.S. stock on your behalf. And that's the core benefit, right? That's the whole point.
Exactly. This is a masterful regulatory maneuver. The tokens mirror all the economic effects, like dividends and corporate actions. But the structure bypasses two major costly hurdles. First, complex cross-border custody requirements for physical U.S. shares, which are just an administrative nightmare. And second, complicated compliance requirements across dozens of foreign jurisdictions.
So the CFD structure lets them offer worldwide exposure to U.S. stocks almost instantly, and with far lower regulatory overhead.
It massively reduces friction and time to market. They can offer a global product without needing a physical bank or brokerage branch in every single country.
But this strategy still needs a robust regulatory backbone, doesn't it?
It does, and they've built one. The One More Money blog highlights their carefully constructed dual licensing system. They use their MiFID II brokerage license, primarily through their Lithuanian entity, to legally offer these CFDs across the European Economic Area.
And MiFID II is like a passport for financial services in the EU.
That's essentially a passport, yes.
Yes.
And additionally, through the Bitstamp acquisition, they got access to an MTF, a multilateral trading facility license in Slovakia for digital assets trading.
So the MiFID II license is their European passport for synthetic products, and the MTF license gives them the framework for running an exchange-like venue for digital assets. That dual legal foundation seems critical for scaling up.
It's the whole game. Now, the technical execution requires next-generation infrastructure. Initially, Robinhood is deploying its stock tokens on an external Layer 2 network, like Arbitrage.
Which is a common and secure choice.
Very common. And for low fees, high throughput. It lets them experiment with the tokenization concept quickly and safely.
Using an established Layer 2 is smart for speed, but the One More Money blog really emphasizes that the truly significant strategic step is their quiet development of their own proprietary L2 blockchain, the Robinhood L2. Why move away from established chains like Arbitrum? Why build their own?
It all comes down to vertical integration, control, and fundamentally future fee capture. When you rely on an external chain, you're subject to their governance, their fees, their technical limitations. Building a proprietary L2 would allow Robinhood to control the execution and settlement environment entirely.
Okay, so let's break down the goals of this proprietary layer 2. This seems central to their long-term moat.
The goals are profound. First, they aim to unify liquidity. So instead of having separate liquidity pools for crypto, stocks, options, and RWAs, they can create a single, continuous, highly liquid marketplace on their own chain.
That's a big deal.
It is. And second, it reduces their long-term dependency on external chains, which slashes third-party costs and increases their profitability.
And I'm guessing the regulatory angle here is massive, which is something a public, permissionless chain can't easily replicate.
Precisely. By owning the chain, they can program advanced on-chain compliance right into the infrastructure. This means if a future regulation requires specific identity verification for a transaction or to block certain geolocated users, the Robinhood L2 can enforce it through smart contract code.
Wow.
This ability to offer high-level programmatic compliance is a massive differentiator for a regulated financial company moving into crypto. And on top of all that, controlling the network means they capture all the transaction and network fees, not just the PFOF rebate, which significantly increases their overall fee capture. They're integrating vertically into the settlement layer of global capital markets.
This entire structure, the high-margin crypto focus and the proprietary L2, it seems designed to maximize the profit opportunity created by these regulatory differences. The One More Money blog rightfully labels this the regulatory arbitrage mode.
It is the foundation of their current extraordinary profitability. We already established that equity PFOF is saturated, it's thin margin, and it's heavily regulated. Crypto PFOF, however, currently exists in this sort of regulatory gray zone in the U.S., and that allows for that 20 to 70x margin advantage.
And this arbitrage creates a unique, defensible, competitive advantage against the traditional brokerages.
It does. The traditional players are often bound by legacy systems and, frankly, regulatory hesitance when it comes to leveraging this crypto profit opportunity in the same way. Robinhood, by embracing this gray zone, can structure trades more flexibly, avoid stringent exchange routing obligations, and maintain those lighter reporting requirements, capturing those huge rebates.
So until regulators decide to apply the exact same level of scrutiny to crypto PFOF as they do to equity PFOF, this remains a significant and highly profitable moat.
A massive moat. They are using their licenses and their tech infrastructure to position themselves at the intersection of the highest margin, least regulated, and most technologically innovative parts of the global financial market, all at the same time.
Okay, so let's look forward. Let's talk about the risks, the challenges, and the long-term outlook.
Right. So the current tokenized stocks in Europe are synthetic, they're CFDs. But the long-term vision, which the One More Money blog emphasizes is the ultimate goal, is far grander.
What's the end game?
The endgame is shifting to one-to-one redeemable tokenized stocks with real primary on-chain settlement, facilitating cross-border trading without any reliance on traditional intermediaries.
Moving to one-to-one redeemable assets. That means they are effectively replacing the function of the current clearing and settlement systems. So beyond the regulatory arbitrage, why is achieving fully on-chain settlement so transformational for efficiency and profitability?
The efficiency gains are truly disruptive. First, profit increases because they control the execution and the spread entirely on their own chain. Second, access expands. Market hours shift to true 2047 global availability.
No more waiting for the opening bell.
None. And third, the current complex and archaic clearing costs just collapse, and the collateral requirements associated with trade settlement shrink dramatically. You eliminate the complex back-office infrastructure that currently burdens traditional finance.
And this also addresses systemic risk, which is maybe the most powerful argument for tokenization. The move to T+0 settlement.
Exactly. The shift to instant on-chain T+0 settlement could eliminate the current T+1 settlement cycle in the U.S. equity markets.
Yeah.
I mean, we all remember the GameStop squeeze in 2021.
Of course.
Those massive collateral calls that forced Robinhood to restrict trading were entirely due to the T+2 settlement delay at the time. Moving to instant T+0 eliminates that liquidity crunch risk because the trade and the cash collateral are exchanged simultaneously on the blockchain. The idea of T+0 isn't just a technical upgrade, it's a stability upgrade for the entire market.
And beyond stability, this technology has the potential to fundamentally disrupt the established hierarchy of traditional finance.
The potential for disruption is vast. Tokenization enables new financial opportunities that are currently impossible. Think about creating pre-IPO secondary markets, where employees and early investors in venture-backed companies can sell their equity before the company goes public.
That would unlock so much liquidity.
Years of locked-up liquidity. It allows for continuous 247 global price discovery for assets that are currently limited by New York trading hours. Robinhood is positioning itself to be the platform that hosts this new continuous market, which challenges the dominance of traditional investment banks and stock exchanges.
That potential is clearly enormous, but so are the risks associated with pivoting this sharply. Let's look at the primary challenges outlined in the One More Money blog, starting with what has to be the #1 threat to their model: regulatory risk.
Regulatory risk is the sword of Damocles hanging over Robinhood's high-margin business. If the regulatory environment shifts, their profitability could be fundamentally undermined. We need to watch 3 areas specifically.
Okay, what are they?
First, the most immediate threat is the potential restriction or outright banning of crypto PFOF in the U.S. If regulators treat crypto PSOS like equity PFOFs, those 30 to 70x margins, they vanish overnight.
Wow. Okay, that's #1. What's #2?
Second, international regulators could decide that CFDs, even if they're tokenized, must be regulated as full securities. That would reintroduce the very cross-border compliance complexity Robinhood sought to bypass in the first place.
And the third?
Third, any tightening of international cross-border trading rules could severely hinder their global expansion plans, particularly in the APAC region where they're investing so heavily.
So it's a business model built on efficiency, but that efficiency is currently protected by a lack of regulatory clarity. What about the technical risk? I mean, building a proprietary L2 and moving billions in customer assets onto it sounds risky.
The technology risk is substantial. Anytime you rely on smart contracts, you introduce the risk of vulnerabilities or coding errors, which could lead to devastating exploits. They face risks with the Layer 2 scaling solutions and the bridges needed to connect their proprietary chain to other public chains. We've seen major bridge hacks result in the loss of hundreds of millions of dollars across the industry.
And the nature of Robinhood's model custodial tokenization, meaning they hold the keys and manage the technical complexity for the user, that just heightens the trust factor, doesn't it?
Absolutely. A single major on-chain exploit, whether it's due to a failure in a smart contract audit or a security breach in their custodial wallet infrastructure, would instantly destroy user trust in their ability to make this transition safely. Plus, there's the risk of liquidity fragmentation. If they move assets onto their own L2 too quickly, the liquidity might remain scattered across older venues, making the new platform less functional. They have to execute flawlessly on technical security and liquidity migration.
So despite these significant risks, Robinhood management seems incredibly confident in their trajectory. And that confidence is backed by several strategic moves highlighted in the blog.
The strategic momentum is undeniable. The swift integration of Bitstamp immediately provides globally recognized crypto exchange infrastructure and licenses. Their global footprint is accelerating. You can see that with the new APAC headquarters in Singapore, alongside their robust growth in the EU, they're planting flags worldwide.
And often, the ultimate signal of management belief doesn't come from press releases, but from how they spend their capital.
And that's where the $1.5 billion share buyback authorization just speaks volumes.
That's a huge number.
It is. Authorizing such a significant repurchase of their own stock signals that management strongly believes the current market valuation does not yet fully reflect the immense long-term value embedded in their crypto infrastructure and the tokenization strategy. They are literally putting their money where their strategic plan is.
That strong internal belief is reinforced by their public messaging, too. They aren't treating tokenization like some kind of side project.
Not at all. Management views tokenization as, and I'm quoting here, one of the most transformative financial innovations of this decade. They are signaling to the world that they intend to be a central architect of that transformation, moving from disruptor of the brokerage industry to disruptor of the clearing and settlement industries.
So let's bring this all together. Let's talk final thoughts and the investor perspective.
Okay, to synthesize the entire deep dive, the bull case for Robinhood rests on 3 powerful interconnected pillars. First, that remarkably high-margin crypto revenue engine driven by the unique PFOF structure. Second, the aggressive future-forward investment in proprietary Layer 2 infrastructure, which positions them as a leader in global tokenization. And third, their proven financial health reflected in robust operational leverage, strong profitability, and substantial cash reserves.
So, given this massive transformation, Who is the ideal investor for Hood today? Because it is fundamentally not the same company it was during the meme stock era.
No, it's not. The One More Money blog suggests Robinhood now appeals to several distinct investor groups. First, investors who are profoundly bullish on the concept of real-world asset, or RWA, tokenization, and believe this will be the next trillion-dollar trend.
Okay.
Second, dedicated crypto investors who are looking for exposure to Web3 infrastructure and tokenization through a regulated, publicly traded company with mass consumer reach. And finally, long-term believers in the inevitability of 247 tokenized markets that completely break free from the constraints of traditional exchange hours and T+1 settlement.
So the ultimate synthesis here is that Robinhood has successfully moved beyond just selling zero-commission brokerage services. It's now emerging as this critical bridge connecting the highly regulated traditional financial world with the permissionless, efficient world of blockchain and tokenization.
That's the perfect way to put it. They are positioned to fundamentally reshape global access and settlement infrastructure, moving money and assets faster and cheaper than ever before.
Which brings us to our final provocative thought for you, the listener.
As we conclude this deep dive, I want you to consider the implications of moving toward a world T+0 on-chain settlement, which Robinhood is actively building. While the speed and efficiency eliminate systemic risks like collateral crunches, how might this relentless pace change the role of the individual retail investor, Robinhood's core customer, when institutional high-frequency trading firms can react instantly, around the clock, with zero friction?
That raises an essential question. The speed of settlement is a technical benefit, but the speed of trading introduces a whole new level of speed-based competition. It demands continuous vigilance from the retail investor. It transforms the market into a truly global, non-stop arena. That is definitely something for you to mull over as this tokenization transition accelerates. Before we sign off, we must briefly read the mandated disclaimer from the One More Money blog. Disclaimer. This article is for educational purposes only and does not constitute investment advice. Investors should conduct their own due diligence before making any financial decisions. We are not responsible for any investment losses incurred based on the information provided in this article. Thank you for watching. We have great appreciation for you joining us for this deep dive into Robinhood's crypto era and its transformation into an on-chain powerhouse. If you are interested in U.S. stock investment and staying ahead of these massive shifts in the financial world, please subscribe to the One More Stock channel so that you will not miss any of our latest video analysis in the future.
And please, do like and comment. We really want to know how you think about this topic and what you want us to deep dive into next.
We truly appreciate your support. See you again in the next stock analysis. Goodbye for now.